Hello, everyone, and welcome to The Buck Stops Here. I am Catherine Murray. Well, I'm very pleased to have our next guest join us because we're going to talk about two key items that I really believe investors need to get right in order to position themselves properly to be able to profit. That, of course, is inflation and what to expect in the equity markets for this summer. Vincent Deluard is joining us. He's the Director of Global Macro Strategy over at Stonex. Vincent, great to be with you today. I really appreciate getting your thoughts because I know you've been writing about inflation and the heads up on it for the past 6 years, and it's important to get it right. So thank you.
Pleasure to be here. And as you mentioned, I've been obsessed about inflation for 6 years now. So as any sort of obsessive person, I like to keep talking about my compulsions. So thank you for giving me this opportunity.
I'm going to indulge you then much further today, because I really do believe it's important. And when you have the media, the narrative basically saying, "Don't worry about it; it's transitory." I mean, that's a couple of years ago. You get that from political officials, the same scenario. But yet, if you're a Canadian or American or anybody really around the world, you're feeling these shelter costs, you're feeling oil, you're feeling fertilizer, and that's just beginning. So can you step back and tell us exactly what you think we're seeing now?
I mean, if I really want to step back on the topic of inflation, I think there's two issues to keep in mind. Uh, One, and I think you're alluding to it with the shelter issue, is the inflation and CPR are not the same thing. If you like paintings, I like there's a Magritte painting of a pipe, and it says "Ceci n'est pas une pipe" for your French audience. And the idea here is the representation of the thing is not the same thing as the thing itself. And I think that applies to inflation, that the CPI is not inflation. And there are things that can impact the CPI that do not really translate into people's lived experience. And I think that's what you're alluding to, right? Things like shelter in the US, 65% of Americans own their home. So this kind of fictional rent that they would be paying themselves, which is measured using a somewhat of a biased survey and then hedonically adjusted, which is about 35% of the urban CPIU in the US, doesn't really impact people. Or I would mention also health insurance costs that are misweighted and miscalculated. The conclusion I draw from that is for much of the past 3 years, we had a fall in the CPI from peak of about 9%. We never got to the 2% target, but we got close to. But that was certainly not felt by people. The CPI fell, inflation did not. The second big picture thought I would have on inflation is it's a complex social, economic, and political phenomenon that usually plays out over time in waves. And central bankers have this tendency to try to attribute it to one cause and to make the case that it's transitory. Oh, don't worry, it's just used car. Don't worry, it's just shortage of chips. Don't worry, it's just the sanctions on Russia. And if you understand, I mean, it's kind of like the same difference there is between notes in a symphony and the music itself, right? I mean, you can arguably don't. No, it's just a sequence of notes. Well, at the end of the day, it's music. So I think it's important that people listen to the music instead of getting confused by central bankers who try to just, pinpoint it to one single cause. It is never a single cause phenomenon, or very rarely. Certainly
Yeah,
not.
yeah,
Not in, yes.
that's a great analogy in terms of listening to the music as opposed to just the notes that they keep giving us and or telling us. So when you take a look at some of the factors that you do see as inflationary, I was really surprised in your note to look that, defense spending will likely be up 40% next year.
Yeah. So there's famous quotes about Milton Friedman who says inflation is always and ever a monetary phenomenon. I would rephrase that and argue inflation is always and every a fiscal phenomenon. Monetary just accommodates the fiscal. At the end of the day, someone is doing the spending, right? So the spending is the accounting record of fiscal spending. If we look at the big blocks of the U.S. budget, we're in a situation that I would call permanent stimulus. The four largest expenses of the U.S. budget grow structurally faster than GDP, which is the definition of stimulus, right? You spend more than the economy is growing. So what are these four items? The first one, obviously, is
Vincent, I'm going to stop you. I'm going to stop you there, and we'll pick it up on the other side of the break. So Vincent, you were essentially saying that the spending, if inflation is spending, it's fiscal policy, and that the amount of spending going on is far, far higher than what we're taking in or creating from a GDP perspective.
Correct. And if we go down the list of this idea of permanent stimulus, so again, basically it's almost $1 trillion item, and a bit more because everything inflated. But if you look at US budget, we spend about 6-7 trillion a year. And you get the big chunk. So one chunk is Social Security. Now, of course, that's growing faster because it's inflation adjusted, right? So already by default, you grow at least as fast as inflation. And then you have the shock of the retirement. Then you have entitlement spending, Medicare, Medicaid. And this is growing extraordinarily fast. Especially drugs, growing by 20% a year for 4 years now. The third one would be interest expense, and that's basically a function of rates. And as rates go up, the debt reprices. That's the most dynamic element of the US budget right now. We're paying more than $1 trillion in interest expense. And finally, I'm getting to your question. The last one is military spending. Where we have this plan for a 1.5 trillion Pentagon budget next year. That would be up from a little less than $1 trillion, so close to 45% increase in military spending, which makes me conclude that we haven't felt the inflationary impact of the war. War, if you can think of it as a buy now, pay later scheme. Right now, the bombs that have been dropped on Iran were paid by earlier budgets. The soldiers that were moved into the Persian Gulf would have been paid anyway, if it stayed in Virginia or not. So the spending usually happens about 8 to 12 months after a major conflict starts. We saw that with Ukraine. We saw that with the Iraq surge. We saw that with Afghanistan. So we still have to deal with the fiscal consequences of the conflict. That fiscal shock is coming for late this year, early next year when the budget passes.
What about the impact of oil? Because many people say as the strait opens, as there's more movement, that should ease the effect of oil, and that can be, and they show this, I believe, historically, that's a short-term impact. And I believe, you tell me, but that's why the equity market seems to be looking through this and past this.
Yeah, the first point I would highlight is the if in your the conditional in your statement is quite important. We've been talking about if or when the strait opens for close to 3 months now, and I hear we're close to a deal today, as we were the week before, and so forth. So I would take that with quite a good deal of skepticism. But let me accept your premise that somehow we get a deal. I'm not convinced that we go back to 60 or sub $60 oil, because we've accumulated, every day since the crisis, we basically lose about 13 million barrels of oil from oil that's not being produced. And now, where is that coming from? That's coming from strategic reserves. Now, fortunately, we went into this conflict with massive stockpiles in China and a U.S. administration that's more than willing to deplete the SPR. And we were starting to see these huge draws. So we've drawn close to 1 billion barrel from stocks, from inventories of petroleums. That will need to be rebuilt. And that will add close to 1.5 million barrels to demand for a year. So again, we had a market that was supposedly in a very small surplus coming last year. Just this inventory effect would tip it into deficit. And I'm not even talking about the physical damage that was done to some of the oil producing infrastructure. We've certainly seen Russia get hit quite a bit by Ukraine, and of course in the Persian Gulf, some of the fields have been hit themselves. First, I'm not sure that we get a peace deal, and even if we do get a peace deal, of course, oil prices are going to come down. There's some premium in the price, but it's not going to come down all the way back to the low 60s the way it was before.
Right. And I think that the market is starting to believe that that will be the case. There's going to be a new higher level band for the price of oil. And I do hear it kind of around that 60 to $80 mark. It's interesting though. It seems as though the market is believing that this is okay. We only have about 10 seconds less left in this segment, but does 4.5% really reflect on the 10-year yield, what we're talking about?
Um, I wouldn't think so. I think eventually we'll see 6% on the 30 year and 5% on the 10 year.
Vincent, when we talk about inflation and the impact that that has on one's portfolio, people really have to think about it and understand it. One of the aspects I didn't quite understand in one of your reports was that the inflationary energy trapped in wealth effect is a coil. I'm not wording it correctly. But what do you mean by that?
Well, what I mean is we've come through a really historical run in asset prices, and whatever asset you look at, whether it's gold, whether it's real estate, or it's cryptocurrency or stocks. And I'm going to take stocks as an example. About 17 years ago, the S&P 500 bottomed early March of 2009 at 666. Anonymous number, and we're looking at more than 7,000 today. If you do the compound rate, that's about 17%. So stocks have compounded by 17% for 17 years. That is both the longest and the greatest bull market in history, if we take it, which I think is correct, from 2009. Um, Now that what represent is an incredible amount of wealth creation, at least accounting wise. If we look at household net worth, meaning if you take the value of all the U.S. assets minus the liabilities, it increased by $100 trillion. I mean, these are numbers that just are completely mind-boggling. I mean, $100 trillion is like 6 or 7 times U.S. GDP. Uh, Why do people own assets? I mean, ultimately it's to transfer consumption from the present to the future, right? I mean, the only reason you're saving money is so that you can consume in the future. So we can think of this massive accumulation of assets as, I think the image is used as a coiled spring, um, potential kinetic energy that's being trapped. Right now, it's caught in financial assets, but we don't know. It might uncoil, and when it uncoil, it will eventually uh, be converted into things that people can consume. Now, could the big IPOs of this summer do some of that? Yeah, you have probably a lot of people who have worked very hard and are locked up in shares that are very highly valued, and they're probably looking for some liquidity. So when we think about the potential drivers of secular inflation, I think it's important to keep in mind that there is a relation between asset price inflation and real world inflation. That this relation is not linear. It typically happens with a lag, but we went through an extraordinary bout of asset price inflation. It would be very unlikely that at some point there are bridges between the real world and the financial world, and at some point one will leak into the other.
So, what does that mean then in terms? There's so many different types of assets, whether it's real estate, commodities, financial assets. With your secular inflation call, high conviction call that you have, what does that mean in terms of what one would want to overweight or underweight?
Well, it depends at what time and at what level, right? I mean, inflation doesn't have you cannot just say, oh, just, buy gold, or even though I do like gold, but, it's more complicated than that again, because inflation is a complicated phenomenon. One thing for sure that you do want to avoid is long-term duration government bonds. That's a call we consistently have. For the past 5 years, I've recommended a very simple strategy called break-even strategy. You own inflation-protected security, TIPS, and you sell a corresponding maturity treasury security, and that strategy returns 7-8% a year with almost no volatility. I would still recommend it because if I look at the level of break-evens, I don't think it reflects the true level of inflation. So avoid duration, avoid long-term fixed bond. For stocks, it's a bit more complicated because there's kind of a two sides to inflation. The first wave of inflation typically feels good. You see everything go up. And remember, we live in nominal world. So you don't know when earnings go up by 25%, you don't know if it's, suddenly you became more productive or just everything costs more. And because of the way accounting works, your inventory at sold at lower cost. So initially inflation boosts margins. I suspect this is what we've seen for the past 5 years. The first wave of inflation typically feels good. My idea is that we are getting to the transition point where we realize this kind of nominal illusion starts to dissipate and equities stop being high performing assets. So it will be maybe a time where you'd want to move from an structural overweight into equities as a growth asset, nominal growth asset, into maybe something a bit more defensive. Commodities, obviously, precious metal, cash, crypto, as we get to the kind of, and I worry that this summer is going to be the transition to kind of stagflationary, kind of like second end of the 1970s for people who love financial history, is really where the pain of that inflation shock was felt 5 years after the start of the wave, in the same way that, yeah.
So, Vincent, you believe that this summer is when we're going to start to see and feel the effects of this secular inflation, and that it will be a turning point in the equity markets.
Yeah, that's correct. So, I mean, kind of almost like a broken clock, bullish on stocks and growth for the past 5 years because of this view that nominal growth was higher than what was reported and inflation was higher than the CPI. I suspect this summer is going to be that transition. Part of that is this 5-year cycle of inflation that I was describing. You can think about in the 40s, 1942, 47, 52, comes back in 5-year waves. In the 70s, 70, 75, 79. So if we just apply the same logic, 2021, 2026 would be the second wave. We're just on target. Part of it is, I think, growth. And that's really new for me. I worry that growth is actually finally slowing. And the way I've tracked growth is by looking at tax collections, which I think have been a much better and more consistent indicator than things like PMI or sentiment survey that are skewed by, I think, extreme polarization. Tax collection grew very, very fast in the first 2 months of the year, almost more than 10% personal income tax collection. And it has fallen from a cliff since end of March. And I'm not sure why. I mean, it matches the timing of the war, although it's not clear to me why, because I don't think we've seen unemployment rise significantly. But the fact is, income tax collection have halved the growth rate income tax collection have halved in 2 months. And I've been following this data for close to 20 years now. It's very rare to see such a rapid slowdown. Now, the only reason we're not in recession today is because we came from these very high growth days. So it's not catastrophic levels still, but the slowdown is really impressive. The other tipping point, I think, is on credit. We've had, all these low-end consumer issues for a long time. I mean, if you look at delinquencies on credit card, auto loans, car loans, it's been going on for a long time now. The countervailing argument, which I think is generally correct, is it doesn't really matter, right? I mean, at the end of the day, we have a society that's so unequal that the bottom half is NPCs, non-playing characters. All that matters is the top decide. We are starting to see some deterioration in some squeeze for high decile people. You see, for example, a high amount of people making emergency withdrawal from the 401ks. Typically, only high income people have 401ks. You see a home equity line of credit, so people borrowing against the value of their homes, even though the rates are higher and then the value of the home is lower. You start to see, of course, job cuts. I mean, big tech. I'm speaking to you from San Francisco, where we have this tale of two cities, if you will, where you have the AI engineer, who gets $100 million signing bonus to work for Anthropic, and then at the same time, you probably have 10,000 kind of mid to, and even some case senior level software engineers at Meta, at Salesforce that are being let go. So the very top of the K, you're truly a car class, if you will, it's still okay. But I think within the top of the K, you see another K forming, where the kind of, wealthy millennial, college educated, city living that had been doing well, that carried the US economy, starting to feel the brunt of a weaker job market, higher oil prices and higher rates. And at the same time, there is no real engine of growth outside of this kind of data center boom that doesn't employ a lot of people. So that would be the third tipping point of, with the growth, inflation, credit, and then possibly liquidity. I mean, we're bracing for a historical IPO summer with close to $4 trillion worth of companies. Now, they're not going to raise 4 trillion, right? Typically, it's, you think about SpaceX, they're going to try to, 2 trillion valuation, raise 75. But even so, if you look at the amount of equity that's going to be drained from the equity market is going to be quite high. And then that drain may not be so high at the beginning compared to your IPO, but it's going to keep going as, founders vest, people who are locked up will sell. These companies have been issuing stock options for a long time. So it might be kind of death by 1,000 cuts, even though the shock in the summer is not maybe as large as one might fear, but it's going to keep going for some time. If I were to pick a time to get out of stocks, I think the summer after the kind of World Cup and anniversary festivities would probably be a good time to take a bit of money on the table.
Okay, Vincent, we have to leave it there. I could speak with you for so much longer, but thank you so much for sharing your insights.
Pleasure.